Welcome to the Financial Thought Exchange podcast, where you get a little wiser by learning from the leading thinkers in finance. I'm your host, Lotta Moberg, and today my guest is Nick Cleary, who is senior partner at Vantage Infrastructure, where he leads the North American business, including the investments or origination, execution, and portfolio management. Welcome, Nick.
Thanks for having me, Logan. Pleasure to be here.
So great to have you. So this conversation is part of our four-part series, video series on alternative credit. We're launching this to highlight and share some of the content from a piece that we're putting out with the Research Foundation. It's called An Introduction to Alternative Credit. It's a collaborative project between the Research Foundation and the CFA Society of New York. And in this piece, Nick wrote a chapter for us. It's called An Introduction to Infrastructure Debt. So thank you so much for your effort in doing that. I know there was a lot of work for each chapter, so we're really happy about this piece and happy for the work that you put in. So maybe we should start with just giving people an overview and a sense of what we're talking about here. Infrastructure seems to entail so many different areas. How would you generally describe this field? And are there any kind of commonalities in the economic characteristic and risk profiles that you would highlight in terms of in the package of infrastructure debt?
Yeah, happy to. Infrastructure does entail many different characteristics, and that's what makes it sort of a unique but also a relatively specialised alternative asset class. At the very fundamental core of it, infrastructure is a real asset that's providing an essential good or service to an economy and its community of people. It's what keeps the lights on, the buildings warm or cool depending on the season, underpins communication, and allows things like the food and the clothes we might order online to be delivered at our door quickly and affordably, and much more. So infrastructure, while it's a generic title, infrastructure underpinning that is not generic. These are usually quite complex operating assets and businesses that do vary by region and sector, and that's what drives a relatively wide diversity of investment profiles, but also this low correlation to other liquid and alternative asset classes, which is a bit of a thematic you'll hear consistently across this discussion of infrastructure. But there are some key commonalities that sort of ties infrastructure together. I typically think about these as there's four fundamental pillars. The first and foremost, it is a tangible physical asset. So it's a real thing that does a real thing in our economy. It also, the thing that it does is it provides an essential good or service, and not just to an individual or a small group, but usually across an economy or to a relatively large part of the market or economy. It also, on the third pillar, it has relatively high barriers to entry. These barriers to entry take many forms, such as sort of regulation or just simply the economics and the space required to build an asset. And fourth and finally, which sort of really goes to the credit profile of infrastructure and infrastructure credit, infrastructure typically has long-term contract and are quite highly certain cash flows. So while it is these elements or these pillars make it somewhat unique and complex, the asset itself does have a very long track record. As a private asset class, it's been around for over 40 years. And these key risk characteristics we've seen have been this resiliency to many unexpected events over these cycles, things like linkages to economic growth and inflation sensitivity. So what does this mean in terms of the risk profile that infrastructure has? It's very much an investment-grade bond-like risk profile. And that's really why when infrastructure equity investing appeared, it appeared as an alternative to fixed income allocations. But today, infrastructure debt, which is probably the largest or is the largest part of the investment opportunity globally, is expanding that opportunity set to other investors and investors not only across fixed income, but also to real asset investors and increasingly private debt investors, where infrastructure is finding itself quite a unique and long-term home in investor allocations.
So how should we think of this in terms of government versus private sector? Most people, when they think about infrastructure, you might think about the government. Government it's tax money and you spend it on infrastructure. So what is the context in which we normally see then private sector being involved? Is it often a joint project with government and private companies, and then you're lending only to the private part of the venture?
Yeah, it's evolved quite a lot over the last 30, 40 years. Infrastructure has largely become a private investment asset class. So today, infrastructure debt um, is primarily financing private infrastructure projects. And this is over half the infrastructure investment market opportunity and growing quickly as there is an increasing need to not only renew and replace existing assets, but to invest in new assets that support sustainable growth, but also increasingly funding new opportunities like energy transition. So to give you a few examples and a bit of information around this, governments in the G20 in 2022 invested around $1 trillion in infrastructure, and this is from the information from the Global Infrastructure Hub. Now, this is about 1% of GDP, which is well short of what typically gets cited as the 2 to 4% percent of GDP required to be invested to simply maintain the infrastructure stock we have today. Hence, there's a large and growing investment gap that is largely being filled by the private sector. And if we then look at infrastructure debt, the main infrastructure debt markets of North America, Europe, UK and Asia Pacific, so around half of that G20 I quoted before, each year that market alone, or those markets alone, are issuing around $1 trillion of debt, primarily from banks, but increasingly from investors directly and specialist infrastructure credit asset managers. And to give you another example, sort of closer to the US market, the US has traditionally funded a lot of its infrastructure from the government balance sheet. For example, I think many investors are familiar with municipal bonds, which have financed a lot of infrastructure in the US. Now, the amount of municipal bonds outstanding has remained relatively static over the last decade, but during this time, the infrastructure investment in the US has increased 3 to 4 times, which sort of speaks to that constraint of traditional funding sources and the growing role for the private sector to be involved in the financing and investment of infrastructure in the US and globally.
So that growing opportunity then for the credit part of infrastructure debt, that is not because the government is spending more on infrastructure projects. It's actually because the private sector doing more in this space.
Yeah, correct. In fact, governments have been spending less, and there's not only constraints on the amount of funding governments can direct to infrastructure relative to their other needs they need to fund, but I think one of the other key themes we've seen is the need for investment in infrastructure today is beyond the sort of traditional bridges and roads that governments used to fund. It's increasingly things like technology, fibre, communication networks, more efficient transport systems, so upgrading airports, and increasingly energy tradition. And this is not only a sector that's new to governments, but it also requires some specialist expertise, and that expertise is most often found in the private sector, which is why governments need to rely on the private sector to come in and help fill this infrastructure investment gap.
So is that the kind of areas then that most of the private credit opportunities lie, which is these like communications, as you say, as opposed to the old, we're thinking old infrastructure, we think of bridges and roads, as you say?
It varies globally. I'd sort of draw some distinctions. I mean, I think the US is a very unique market where traditionally the governments have funded and owned a lot more infrastructure and continue to do that. So in the US, there's more a focus on using the private sector to invest in the new sectors as opposed to investing in the traditional infrastructure sectors. But in the more mature infrastructure markets like Europe and Australia and even Canada north of the border here, they've relied on private sector to fund those traditional assets as well. For example, the Australian government has a project or a program called asset recycling, where the government's privatised the mature assets and used the proceeds from those funds to invest in new infrastructure assets or support the development of new infrastructure assets. Europe does it differently, as does Canada and the US. So everyone's slightly different, but there is still that fundamental need to increasingly bring in private sector expertise to solve the infrastructure challenges, not only of today, but going forward.
Yes, that's very helpful. So we can think of private involvement here, right, in two ways. One is you have government procurement procedure where they're saying, we're going to build this bridge, you give us good bids, and that's private sector coming in. And that could be an opportunity for those companies. The companies could raise debt. But you are actually talking about not even that. Like, the government is not doing procurement. They're saying, we're not doing this. Could a company then come in? And then the question is, well, how does the company actually get the money for that? We know highways, you sometimes pay tolls, but beyond that, it's hard to think about infrastructure areas where it's easy for the private sector to collect the money from the users.
Yeah, correct. The maybe to add a little bit more colour behind that is there's lots of different models for how infrastructure gets financed or owned, or even leased from government and handed back over time. But there is always a sort of a strong government linkage in some way. I think the classic example is the government, like you look in New York where we are today, there are not going to be 2 JFK airports. New York has 3 airports and there's no room for any more. So the government's going to limit where new infrastructure assets can get built. And that's important also to do it efficiently. Infrastructure has a long-term and a high cost base, so there is a lot of value from having a sort of a few assets serving a large market. So what that means is there are some projects where the governments do procure it. They run a process and they run a tender and seek proposals from the private sector. And so they facilitate a process to auction or a process to tender for the development and ownership of an infrastructure asset. Often these are called build, own, operate, finance structures, and they usually work under what gets called a public-private partnership for a period of 20 to 30 years before the asset gets handed back to the government. So that's a bit of a classic model, but it's only one model. We see a lot of newer models where it is the user paying fibre and telecommunication. I think it's a classic example today where it's the off-takers and the counterparties are not governments, but there might be a telecommunication company or a hospital enterprise system or even a government off-taker that procures the capacity from the fibre network to facilitate its business and operations. And so companies are out developing those networks in response to that contracted demand. So it's not a sort of traditional government procurement, but it still has that same elements of essentiality and usually relatively high barriers to entry that limits competition, that creates a lot of the resiliency and stability of infrastructure as an investment asset class.
So how big of a share of the infrastructure credit space would you say is that old model of government procurement versus the new model that you described?
Yeah, in the US, I don't have the number to hand, but I would say it is a significant minority of old traditional assets, and the US really uses the private sector expertise in the energy space, but very significantly in the new sectors. In places like Australia, it's probably pretty equally split. There's a lot of using private sector to recycle old assets and to support the development of new assets. In Europe, it's probably similar, sort of equally split between government-supported financing and sort of more independent. It's still classically privately owned assets.
Living up to the name of the old world in that way. So you mentioned in your piece, by the way, that that when we look at these projects, between half and 80% would be financed by debt. Sounds like pretty high leverage. Does that mean that if you're coming in on the equity side, those projects are very risky as a result? Or is there this government connection that kind of compensates for that?
Not really. It does always come back to, what does infrastructure have? It has essentiality. So people generally always need its services there's high barriers to entry, so it's very hard for new entrants to come in and compete. And infrastructure often has very long-term, stable contracted or regulated or otherwise highly certain cash flows that does support high leverage. And the experience with infrastructure debt over many, many years now is even at the 80 to 90% leverage, infrastructure in certain instances continues to perform like as high as a single A corporate credit. So that high leverage is really simply a reflection of the stability of the asset class and the long-term contracted cash flows. It doesn't increase risk significantly on the equity investment side. And I think we've seen, again, through the most recent cycle of higher inflation, supply chain challenges, infrastructure, again, has performed very well on the equity side, which further underpins the quality and the resiliency of what the debt investment in infrastructure looks like. So hopefully that gives you a little bit of colour around that leverage, because it is often a point that people look at comparing infrastructure to a corporate credit. But simply infrastructure has a very different stability, cyclical cash flow profile to a corporate business.
Oh, gotcha. If we think about the different kind of projects, you did mention the telecommunications part and airports. Is there one that dominates a lot that it's like, if you would just go out and do some kind of, if it's possible, a passive investment in infrastructure credit, you end up being exposed to this sector and think about that? Or is it very, very diversified?
It's very diverse and continuing to diversify. And probably what I would say is sort of in infrastructure as a whole is growing and diversifying, but also the characteristics of the subsectors can be quite different. We talked a moment ago about public-private partnerships where the contract and the revenue might be a fixed payment from the government for 30 years. That'll have a very different profile to a toll road or an airport that gets a fee based on the number of cars or planes that land or passengers that depart the facility. It'll have a very different profile again to a renewable project that might have a contract for the volume it produces from a utility. Again, it might have a different contract to a telecommunication company where the off-takers, say a company or the cell tower company, is buying the capacity or buying a collection of services along with that capacity. So it's infrastructure over the last 10 to 20 years has just continued to diversify away from these sort of core traditional assets, and sort of the next wave of opportunity we see a lot of opportunity in infrastructure debt is sort of then financing this coming energy transition, which on some levels has been going on for decades already, but it's certainly accelerating significantly now with a greater focus on decarbonisation, improving efficiency and lowering costs to the end users.
So when we have a case when it's a private company stepping in, it's not a government procurement. The government might say, hey, you could build an airport here or do this and that. You mentioned there is the great barrier of entry, and I understand how that is a natural barrier of entry. You need a lot of capital. It's a big project. Somebody has to get the land if there is some obvious space for the new airport and stuff, like things like that. But to what extent is the government also stepping in and saying, well, we're saying this company, we're kind of designating, it's not procurement, but will they designate a company that's taken on to do a project? Or does the government ever just say like, oh, well, we want another airport and this guy's building an airport here and the other one is building, one is going to make it. Let's see what happens. Free market. Like how dictated is it still by the government? How much is the government increasing this barriers to entry as well?
Certainly in very monopolistic assets, the government controls the procurement because fundamentally these assets play just such a fundamental pillar for governments, and the governments have the obligation to procure the best service at the lowest cost for taxpayers. So those more classic infrastructure assets and government procurements are very sort of well-run, efficient processes these days. But in other spaces, the government always has a hand. A good example is in the renewable industry. So if you want to procure or to develop a renewable project and sell solar generated electricity into the market. First, you need to go and procure the land. So you need a site that has good solar irradiance, and there's a pretty wide availability of land. So acquiring land comes with a cost, but it's not particularly hard. But the next two steps are really quite hard. The most critical one these days is the interconnection to the electricity grid. And those interconnections are usually controlled by the utility or a public utility commission that have sort of regulation rules around sort of how people apply for interconnection and the process to be approved and to get an interconnection to sell electricity into that network to generate revenue. I was on a panel recently speaking to some solar developers, and they gave the example, I think, in California, that the time from putting an application in to get an interconnection to the grid today to getting that interconnection can be anywhere from 6 to 10 years. So that instantly becomes a very high barrier to entry to be able to develop a renewable project if you've got to wait 6 or 10 years to connect to the grid. Then once you've got that grid connection, you typically need an off-taker or someone to buy the electricity from you. And typically utilities are the prime buyers of electricity that then distribute this to retail users. We are seeing increasingly corporates come in, particularly in the retail world, as they are focused on sort of having net zero procurement or decarbonising their energy supply. But then you typically need to get some revenue certainty before making the investment in the equipment, which can take anywhere from 1 to 5 years to procure and build. So when you start layering up all those aspects, hopefully that gives you a bit of an example of that concept of a barrier to entry and how complex developing a renewable project may be. But also, I guess, it's the roles of government and other counterparties in there. In the example I just gave you, the utilities in renewables have a large say in terms of the interconnection and the offtake. And utilities are overseen by public utility commissions in the US and other regulators in other markets, which are effectively government organisations controlling the procurement and sale of electricity to consumers.
Yeah, so many of our listeners and viewers here might have gotten a call or an email at some point about some company wanting to sell them solar power and then put on their roofs. And they might say, well, they didn't say it's going to take 10 years to get connected, but that is obviously a very different if you're selling to a private house or household or a company, right? Then it's an easier process to get connected. It's when you're selling into like the big grid that is then going to service the community as a whole, as I understand, right? That's when it
is, but it's quite interesting because in the US in particular, the residential solar industry of selling a solar system to a homeowner to put on their roof has grown significantly, and it's grown in response to the barriers to entry on the sort of traditional energy side that consumers have been looking for lower carbon, lower cost and more reliable electricity. And because of some of the inefficiencies on the utility model, it's created an opportunity for residential solar companies to sell systems to homeowners, and typically under 10 to 20 year contracts where the homeowner pays a fixed amount for that system. And that's generally been delivered to consumers at a lower cost than utilities. And now in the US in particular, we see companies that can aggregate hundreds of megawatts of energy into one portfolio. So we invest, for example, in a number of residential solar portfolios, and these look like diversified nationwide portfolios of operating customers, and these systems have generally performed very well, delivering the electricity at a lower cost. And so, we think that's going to be a really interesting continuing opportunity, but it only speaks to one part of the complexity of the energy system. Residential solar alone is not going to be the source of electricity for everyone everywhere at all times. Neither is utilities. So it sort of speaks to the complexity of, sometimes what's required to get electricity to the homes at different times and in different ways.
You mentioned that these infrastructure companies are generally, so not only renewables, but others too. It's generally a profitable proposition. Um, how did you understand it in the context of what you're speaking about now when we're thinking about there's barriers to entry, but that's because you need a lot of capital, it's very expensive, it sounds like kind of a risky proposition. It sounds like, how do you know if you're going to be profitable in the end? But you would describe it as profitable. So how do we kind of understand that connection?
Yeah, it's profitable, but to be honest, it's not highly profitable. The value of infrastructure is it's a very resilient, low risk, long term investment opportunity and asset class, and that's it. It's where it fits in the ecosystem of an investment. So you don't expect a lot of periods of high volatility or high profitability, but you also don't expect periods of losses or low profitability as well. But when we look at infrastructure assets, because they are these very large, tangible long-term assets, a lot of the financial risk or the investment risk is really on the financing side. So an infrastructure asset might operate with an earnings or an EBITDA margin anywhere from 40 to 80%. And that's because it's sort of day-to-day operating costs are actually quite low. It doesn't need a lot of people to do things. It doesn't have a lot of inputs that need to be passed through. It's a real classic real asset profile. But what that does mean is it then does need a lot of capital. So what that means is that the risk around infrastructure is probably less an operating risk compared to other businesses. It's more a financial risk because it's about procuring sort of the right type of capital with the right tenor and the right profile to sort of sustainably finance an infrastructure asset. And if we look back over the years of where infrastructures, I think performed a lot better than the wider market, where there have been challenges for infrastructure, it's primarily been liquidity events where there's been a refinancing need and infrastructure has a large refinancing need. And if that financing's not available, it creates liquidity, capital, financial risks, but less about operating risks. And that's something that, if we look back over the last probably 20 years now, the GFC was a good example where the risks that emerged in infrastructure were one of liquidity. Certainly not as significant as some other parts in the economy, but it was a risk and an issue. And then fast forward to today, what you've seen open up around infrastructure, particularly infrastructure debt, is a very large alternative credit universe and a range of other investors investing in the space that's actually de-risking and mitigating that financial risk, because there are now greater sources of debt available to finance infrastructure than what 10, 20 years ago it was primarily banks and governments.
Yeah, you'd think that if the demand is so high for that credit, if it's so crucial, right, to get the projects surviving initially as well as an ongoing basis, that would be a great opportunity, right, to step in as a credit provider.
Yeah, it has been. In that, that gap, I guess we were talking about before, I mean, that's the sort of the fundamental opportunity for investors. What we face today is a very steadily growing infrastructure investment need, both renewing existing assets and building new assets. But at the same time, banks have still been the majority financier to infrastructure. Banks are again pulling back and have sort of continually since the GFC pulled back their risk appetite and the amount of capital they can lend to infrastructure. And in the US we're seeing, I think, a further pullback, particularly in the middle market and regional banks. And governments have not been able to fill that gap. So it's quite an interesting sort of market to be in, where you've got this sort of, from an investor perspective, particularly credit, you've got this growing investment need and widening gap that is the opportunity really for the private sector and particularly private investors to fill.
So are banks still dominating? They used to be basically everything, and now
they used to be basically everything, and now they're almost everything. I haven't checked the numbers recently, but, I'd say today banks probably still finance something like 70 to 80% of the global infrastructure debt need. And in markets like Europe and Australia, where they're very bank dominated, that's higher. In markets like the US, where there's a more sort of active and diverse capital markets, that amount is a little bit lower, but not significantly. So it's still very dominated by the banks, and that's certainly one of the key aspects that investors in infrastructure debt need to be thinking about where are these pockets of the market where there's less competition, and where there's a value for a credit lender or a credit investor to find and create value, rather than just competing with banks head on, because the banks are, certainly an essential part of financing infrastructure and play a critical role. But they certainly do have their preferences of where their capital and where they play in the market. And competing with banks often do things to have outcomes that are not necessarily financial. It might be a league table to be seen as the largest lender in the market. They might want to be a sector leader in telecommunications or infrastructure. And sometimes banks fundamentally lend to make a profit on their cost of funds. And a bank lending to make a profit on their cost of funds can be quite different to an investor finding alpha above other investments they could otherwise invest in.
And so as banks step down, even if marginally, the private credit shops that are taking their place then, are they starting credit funds that are infrastructure focused, so that you have your general partners, a limited partner kind of set up? Or is these companies that come in to fund specific, like one-off projects and gather funds for like on a project to project basis?
It varies reasonably highly. I think what we've seen, like 10 years ago, a lot of the original infrastructure debt groups like ourselves often raise money not in funds but in mandates, so sort of bespoke tailored accounts to often very large investors who are looking for a sort of a global solution to invest broadly across infrastructure credit. And then we've also had a growing number of direct investors come into the space. I think that's most notable with insurance companies. Insurance companies are probably the one space that are quite often investing directly. In the US, there's a financial market called the US private placement market. It is a private placement of rated investment grade bonds, and they're arranged and distributed by banks and their agents and invested directly, typically not through funds, by insurance companies who get a favourable regulatory capital treatment for those rated instruments. But increasingly, we are seeing as wider parts of the market want to participate in infrastructure debt, increasingly funds are a very key avenue for a number of investors who either don't have the scale or the sophistication or the preference for a tailored solution like mandates to invest in the space. So today, I'd say that private or non-bank investment universe is spread relatively evenly today between groups like insurers investing directly, specialist managers providing mandates and tailored solutions to invest on behalf of large pension, insurance, or even sovereign wealth investors, and then a growing range of funds across a range of regions, risk profiles, and sectors that are allowing a lot wider participation of institutional investors. But increasingly, actually, retail and high net worth investors are increasingly finding ways, and managers, distribution channels are creating ways for these investors to come into the private infrastructure class, both on equity as well as debt.
And when we talk about then, there's two ways of thinking about this, right? There can be this fund, which the latter case, like you have many investors. And when you talk about a mandate, that means there's one investor, basically, as I said. It could be a sovereign wealth fund that said, I'm going to put money. You never have to go out and raise money then. If it's insurance companies, similarly, there are not many different insurance companies that come together here. There could be just one because they can be very large and put money in the space. Now, if you have a mandate, if you have those cases when you have only one investor, is it usually one project that they're going after? Like, hey, we're going to do this. Like, you take care of getting money into this airport project that we really like, or is it we trust you to pick some good projects for us, diversify across 20 different projects, off you go?
Yeah, correct. Usually it's the latter. It's finding what infrastructure, as I sort of spoke about. It's a very long-term static asset class, so diversification is very important. Investors are typically not trying to pick one asset, have one bet, and that's, I think, really one of the really key differentiators for infrastructure debt versus the opportunity on the equity side. It's very easy to diversify infrastructure debt very significantly globally. So some of those early mandate clients were over $1 billion for ourselves and many other managers. I think about one of our client portfolios today, the portfolio today is over 40 assets globally across a range of different risk profiles and sectors. So typically those mandates are looking for a globally diversified solution or a diversified solution in a specific sector or in a specific region. So it's not as simple as going to just find one project and put one block of money behind that. I think that's certainly not where investors see value, and I think we've seen it over the years. The value of diversification is very important when things change in an unexpected way.
Now, you noted in your piece too that there is limited competition among lenders, among creditors in this space, in infrastructure credit space. Why is that the case? Is that just a opportunity that not enough people have appreciated yet?
There's a range of reasons, and when I say there's limited competition, there are certainly still pockets in our market where there's very high competition and a lot of new entrants coming into the space. I think we've certainly seen in the last couple of years a great interest in infrastructure, generally in infrastructure credit. So we're seeing sort of the next wave of new investors and new managers come into our space. But there's always spaces where there is pretty high competition. I think the examples we often see is this US private placement market in the US, which is focused on privately placed but rated investment grade assets that go to insurers. The European region generally is a quite mature region with lots of lenders. So we see sort of generally high competition there. And more recently, in renewables, for example, almost globally, we've seen a lot of new entrants and a lot of increasing competition come in there. As investors have particularly sought to sort of garnish or achieve their net zero investment objectives, and renewables is a very mature, in our space, relatively straightforward asset class to achieve that in. But there's always parts of this market, and I think we're always surprised by both how large some of these parts of the market are, but also how little competition we find in there. So sort of the key areas we see today is sort of middle market, energy transition. So typically banks are really looking for large, relatively core traditional assets where they can lend a lot of money relatively safely and distribute the debt and make money from the distribution rather than holding of the debt. And what that's meant is smaller, more middle market infrastructure projects don't see a lot of, or in fact see less lending from banks. So that's an area where often the smaller, more middle market assets are slightly more complex. They're not always an investment grade profile, but they're often pretty close to it. It's an opportunity where there is a gap of financing available that creates opportunity. The more recent wave is sort of energy transition opportunities. And these are less mature new sectors where there's just less experience, particularly in the banking community, and often more experience in the investment community from specialist funds. So that's an area where I think we're seeing a lot more inroads made by funds in some of those newer spaces because they have the experience, but they also value probably, I'd say, a slightly higher risk profile, and they're looking for a slightly higher return than banks typically target. And they create some quite large opportunities where there's limited competition.
So the current U.S. administration introduced the Inflation Reduction Act, so-called, for giving out a lot of different monies, a lot of tax credits to renewable projects. Has that changed the landscape here? Has that been a game changer in any way? I was thinking when you're in the smaller projects that you're talking about, whether that has incentivized a lot of these smaller companies to come into the renewable energy space and opening opportunities for lenders in that way.
Yeah, the Inflation Reduction Act, it in some regards hasn't changed. I mean, I think it continues a prior commitment to investment tax credits for renewables, but in other regards, it's changed the energy transition investment universe in a pretty substantial way. So the key things that were quite unique about the Inflation Reduction Act was firstly its scale. It was, one of the largest programs globally to support investment in new energy and infrastructure. It was also quite unique and quite important to understand in the US. It was designed as a 10-year program. So it's proven to be quite resilient to government cycles. And I think one of the other really key characteristics of it was it was not focused on just financing the renewable projects. It was focused on financing and supporting investment in the value chains that support these. So it's focused equally on investing in and supporting the building and the investment in new manufacturing and production and creating jobs. That creates a lot more of a sustainable and a more resilient supply chain to invest in energy transition that is going to take 10 to 20 plus years, not just in the US, but globally. So that program was really created an even stronger floor underneath what was already there. It's extended its reach to support the supply chains and to support a local economy. So it has in itself created a lot of stability. It's also created a lot of financial flexibility of how companies want to go about and finance these investments, and that sort of greater optionality on financing has certainly taken out some of the financial risk of infrastructure. So it has had a pretty dramatic impact, but sort of having been in the industry for many years now, in some regards we were already using the investment tax credits for many years. It's just sort of created more optionality. So, for example, one of the things that was added to the through the Inflation Reduction Act was a higher credit for carbon sequestration, and that's had a pretty immediate impact on making carbon sequestration more affordable in the US. It's also invested in, or one of the things we're looking at these days is EV charging infrastructure. One of the things it's done has subsidised the cost of EVs to consumers, which is helping users of EVs buy EVs, and that's now supporting a larger user base that's required to support the investments in EV charging. And so it speaks to how the Inflation Reduction Act has thought about the value chain of not only just supporting the EV charging with subsidies, but also supporting the end user. That ultimately, I think, creates a more equal, share of the subsidy, and creates a sort of a more stable base against which to finance these projects, because you're not only looking at one program or one type of subsidy, you've got the whole supply chain or value chain sitting behind these investments we make that have this long-term support from government.
Yeah, it's a good point that, even if we think about like a lot of energy credits coming out because of the Inflation Reduction Act now, but it's been around for a long time. It's just a new package on top of the other. There were others out there already. What does it mean for rates in this space, in the sense of if you get a lot of tax credit from government, does that mean that this implicit kind of government backing means that the lending rates are lower for companies like this?
It doesn't mean the lending rates are lower. So if you just to unpack what we mean by an investment tax credit and what that does to a project. So what the investment tax credit does is it enables the developer of that project to own an asset that is a tax credit. So in exchange for developing, say, an EV charging platform or a renewable project, the developer is granted by the government some investment tax credits, and they can then go and sell those credits and generate money from those that they apply to reduce the capital cost of the project. So an investment tax credit is fundamentally reducing the capital cost or the need of third-party financing in an infrastructure project. And that obviously reduces the amount of financing that's needed, that de-risks the execution of that project. But importantly, for the user of that infrastructure, a portion of the capital is effectively backed by the government or by this subsidy that doesn't need a return to be paid for. So investment tax credits primarily reduce the capital cost of a project, and that flows through to a lower cost outcome for users. It's not by any means a government guarantee or a de-risking of the credit profile. So from a credit investor, it's still, while it sort of de-risks the execution of the project, we're still able to find relatively high yields because these are not explicitly government-backed investments. If they were, the return and the investment risk profile would be quite different.
Yeah, no, it's a very good point. It's not a subsidy in the sense that you have a bank account and here is a few $100,000 from the government. I'm so happy. The tax credits are very different. They're very attractive, right? In the sense that it's instead of getting money, then you would then probably need to pay a tax on, even if it's from the government. So you pay some of it back. You don't have to do that. It's not a taxable event in that way, the asset that you're getting, but the assets can be applied only to the money that you would be paying taxes on, which seems to be a barrier to entry for the startups in this space because you can't use it until you're profitable. Right?
It's interesting. The original investment tax credit scheme is exactly that. If you're a company that had these tax credits and you weren't going to be profitable for a number of years, the tax credit wasn't worth much to you, at least in the short term. And that's really how the investment tax credit market started. So most renewable projects have what's called a tax equity partnership that allows the project to sell the tax credit to a third-party investor that comes into the project to buy the tax credit. That does create quite a lot of complexity and a bit of friction costs. One of the things the Inflation Reduction Act created was avenues to monetize those tax credits without a tax equity structure. So it reduced some of the friction costs of some of the complexity we had to deal with in the past. The long way of saying it allows developers of those projects to receive value from those credits earlier, that allow them to accelerate their investment deployment and deliver some of those savings through to the users, or not only the cost savings, but the access to new infrastructure sooner rather than later.
And thus you have a completely new market, which is the tax credit market with tax credit brokers, where you now have middlemen, people making money of this from companies. Sorry, it's really, really fascinating space in that way, how the dynamic of this. I hope our listeners and viewers here are really excited about getting exposure to this space. So how would a person who is a saver wanted some more exposure to infrastructure credit get exposure to it? One, I guess, would be a question of, are a lot of pension funds into this space already, so that you should look into, maybe you do have exposure already, and if not, where should they go to find it?
Yeah, good question. Lots of places. The traditional investors in infrastructure, and particularly infrastructure credit, have been insurance and pensions. For the insurers, it's mostly the insurance general account, using those investments to back their insurance liabilities. And for pensions, it's mostly been the defined benefit pension funds investing, because infrastructure does provide this sort of stable long-term investment that helps match liabilities and back those liabilities. So it removes a lot of investment risk for insurers and pensions. So it's very much traditionally been an institutional asset class that's been challenging for retail or high net worth investors to participate in. But increasingly we are seeing lots of different ways that infrastructure can be invested in, both credit and equity, for a range of investors. There have been in the past, probably less so in the US, more so in the UK, Europe and Australia, listed trusts, listed vehicles that invest, that allow people to participate through a listed exchange with the liquidity and the benefits that come from that. In the US, we've seen a growing proliferation of what's called closed-end interval funds. So these are SEC-registered funds that provide quarterly liquidity, and that provides them great flexibility to invest in private asset classes and pass those benefits on to their investors. So in infrastructure...
And just understand these two examples for first. The trust. So is that like a public company? They're like, we're investing in infrastructure companies and you can buy equities in us and thus you can trade it. That's why it's like...
Yeah, correct. I'm probably using Australian words despite probably living and working in the US for most of my life.
We should clarify where your accent is from, because everybody's been wondering until now. So, yeah.
There's the answer, if you haven't worked it out already. But, the private infrastructure market, maybe to give you a bit of example why you see quite a few Australians in the infrastructure market. Australia as a market has not many people and a few population centres. So infrastructure is very expensive for the country and critical to develop efficiently to allow people and goods to move around. And so in the very early days, a lot of infrastructure in Australia was listed. And there are a number of listed infrastructure assets today, but a lot more of it is in the private market. But in the early days, and we had some experience with this, a lot of credit, we had a couple of credit investment vehicles that were listed on an exchange in Australia. So there are listed ways to get to invest in infrastructure, credit and equity, but most of it has traditionally come through large institutional investors, and that's really a reflection of, infrastructure debt as an asset class has about a 40-year history, which really mirrors the sort of history of private infrastructure investment. But most of that's been in the banks, and it's probably only been the last 10 to 12 years that we've seen a lot of institutional capital come into the space. And now as that institutional capital has matured, we're finding a lot more new entrants trying to come into the space and looking for ways to do that. So we're certainly seeing a growing range of ways for investors to enter the space. But I think, like a lot of alternatives in the liquid asset classes, it is complex, it is specialised, so it's not something for all investors, and hence most of it is brought to the space through institutionally regulated or institutionally controlled investment channels.
So are there not equivalent companies in the United States for the United States investors, like companies that invest in infrastructure projects and are public, so you can invest in their equity?
Yeah, there are a few. I mean, like the classic example in the US is the investor-owned utilities. That's a sort of classic example of...
Say what it's called again?
Investor-owned utilities. So you can, like the classic example is the California utilities, Southern California Edison, and name whichever other one you'd like from California or around the US. So there are a number of publicly listed utilities, but utilities are just one small part of the market. There are a lot of other opportunities. So there are sort of some specific ways to invest in the equities of infrastructure companies. And you do see that. I think you can go and look on most ETFs and find an infrastructure ETF, and you'll find a range of companies in there. Often a lot of utilities, a lot of midstream pipeline companies as well. But that's a very small part, or only a couple of sectors of the overall market opportunity. What we probably don't see today in the US is a lot of ways to invest in the credit in infrastructure. If I sort of compare that to the direct lending market, There's a number of structures in the US, one of the BDCs, business development companies, which are effectively listed credit investment vehicles. So investors can invest directly in private direct lending to corporates. But we haven't seen that level of development happen in infrastructure yet. I think a little bit because infrastructure is still a very bespoke, unique asset class. It's not standardised and homogenous, and it is sort of more complex and longer term, which hence creates its value, its uniqueness, its low correlation, its sort of different credit profile value. But it also means it is harder to fit in a sort of a standardised, sort of commoditised investment structure such as a listed investment vehicle.
So there's no BDCs, business development companies in the US with a pure infrastructure focus.
No, not that I've seen. If someone listening has one and does one, give me a call.
Put it in the comments.
Know about it. But we haven't seen them. But we are seeing in the US
That's fascinating.
A different structure that's called a closed-end interval fund, and these are sort of probably a halfway house between a fully private, locked-up closed-end vehicle and a listed vehicle that do provide quarterly liquidity. And a number of
meaning you can get all your money back or whatever you have invested.
Not all your money. I think the rules are every quarter they must offer a minimum 5% liquidity. So they offer some liquidity, not all liquidity. So you've always got that investment risk. You can't just assume you're going to be able to take your money out when you want, but there is liquidity. And that provides, that's one structure we've seen that's providing greater access to infrastructure credit in the US. If you go to the UK and in Europe, there are different structures and different vehicles. So we do see different solutions in different markets depending on the investor preferences, and then obviously market regulation and what regulators are happy to go through those more retail investment channels.
And in the case of the quarterly liquidity example, that means that you can also invest more every quarter if you want
Correct.
to, which is something you cannot do in a regular fund.
That's both ways.
But this is not a situation where you're owning equity in the company that lends to companies. It's like a fund, like a credit fund. You have your money exposed to the credit.
It always depends on what the underlying is, but there are now a couple, and I think a growing number of these vehicles that their investment strategy, so what the investment vehicle holds, is infrastructure credit. So you can get that specific investment in infrastructure credit.
And they would want to have limited liquidity so that they have some predictability with their projects, but they probably have enough projects, like diversified and over enough time horizons, I assume, for them to be able to offer this kind of liquidity.
Yeah, I think it's a quite good structure. It's regulated. So there are some very specific rules about how much the liquid fund and the liquid direct investments. So often these vehicles do own cash and liquid securities that allow them to back that liquidity requirement, while also being able to invest a very significant and typically a majority of their assets in private liquid asset classes. So it doesn't, I guess the point around that, I think this is something we've all learned in many different cycles in many different markets. There's nothing for free. You can't have your cake and eat it too. There's not, to get access to an illiquid private asset class, that comes with additional risks. And there are structures that provide some liquidity, but I think, lessons in countless cycles have been liquidity's usually there when you want it, but it's usually very scarce when everyone wants it. You really need it. So it's probably a bit of a health warning. You can't invest in private liquid asset classes and expect there to be liquidity, when you may want it. But there's certainly ways to think about creating investment structures to mitigate that for investors.
So speaking of the risk profile, then, what is the default risk of infrastructure projects? Knowing the barrier of entry context here, it seems like that risk will be pretty low. Or how many projects have you seen actually defaulting?
I think you're in this industry long enough, you always see things default and not go well. But infrastructure as an asset class has a very strong default history and track record. And there's probably two things with it. One is the profile of infrastructure credit has a decreasing default rate. So if you compare the marginal default rate of a corporate versus an infrastructure asset, each year the risk of default for a corporate gets higher. For infrastructure, the history has been each year the risk of default gets lower. So typically, infrastructure, when it's in the initial investment, say a greenfield project, when you're first building and financing the investment, it typically has a risk profile of a high BB to a low investment grade. But the experience of the asset class has been over sort of 5 or 10 years, it'll de-risk to a BBB to even as low as an A credit profile. So it's got a very resilient and declining credit risk profile, which is quite unique, which is tied back to those characteristics of essentiality, high barriers to entry, and certainty of cash flow I talked about before. And then the other piece is because you've got a very long-term essential asset backing the credit, typically the recovery, if things do go wrong, is very high and higher than corporate credit. So it does have a very unique credit risk profile, and that's certainly one of the sort of examples of low correlation or differentiation to other asset classes that investors appreciate.
How has the high interest rate environment affected this? Has defaults increased because of that? Like companies realizing that they couldn't pay, they have to roll over the debt and the rates are so high now?
No, it hasn't. One of the characteristics of infrastructure is its inflation protection. So a lot of the contracts for infrastructure allow revenue to increase in relation to inflation. Obviously, inflation is not a direct linkage to rates, but they're very closely correlated. So one of the unique things about infrastructure, and it ties back to this essentiality and often monopolistic aspect, that because it's monopolistic, it has a very fixed revenue stream. But one of the aspects of that is making sure the revenue is indexed to inflation to mitigate the risk of changing costs. So infrastructure as an asset class, again, from an equity perspective, and also from it's certainly underpinned the credit quality, is it's performed very resiliently again to higher inflation or the higher inflationary environment. And again, I mentioned it before, but infrastructure doesn't have a lot of operating cost. So it doesn't have a high cost base. And if it does have a cost base, often it's allowed to pass that through to the end user. So it's not highly exposed to increasing labour costs or input costs to production. But where we have seen the higher inflation rate affect infrastructure is the development of new projects. I think one of the themes we've talked about through this podcast has been infrastructure is pretty complex and it can take a very long time to develop. I think I gave you the example before about the interconnection queues in California. So that might mean it takes you 5 years from developing a project to be able to invest it. And one of the things we've seen happen over the last couple of years, the cost of equipment due to supply chain issues and the cost of capital due to higher interest rates have significantly increased the cost of equipment and the cost of financing that need to be compensated. And that has caused, or it did cause, a pause of projects, particularly in late 22 and early 23, as the industry adjusted to a higher equipment cost and a higher capital cost environment. The classic example of that in the US was the offshore wind industry. Offshore wind is a quite mature sector now. We've been involved in it in the UK and Europe for many years. The US has been developing an offshore wind industry. I think some of these projects have been taking 5 or 10 years to develop. And just as the industry was about to start work on some of the, not the first, but the sort of the next wave of major projects, the cost of inflation on the equipment and also the higher cost of capital caused the economics to require offtake contracts or payments from the utilities that were at least 50, sometimes 100% higher than what they'd originally contracted, which fundamentally meant those projects are uneconomic. So the projects paused before starting construction. and the companies have had to go back to renegotiate the offtake contracts to find a higher revenue source or alternative sources of income to offset that higher cost. So it's a good example of how often risk gets managed in infrastructure. People are not building those projects on spec. They're building those projects once they've got contracted revenue and they've got locked-in equipment costs and locked-in finance costs. And that's a good example of why once these projects start operating, you've got long-term debt financing or at least interest rate hedging. You've got a lot of your equipment costs paid up front, and you've got long-term revenue contracts to create the stability. So the changes we've seen in rates and cost of equipment, did have an impact on infrastructure, but it didn't really impact existing assets. It really just impacted the development, particularly of very large, long-term, relatively low-risk return assets that were quite sensitive to cost of debt capital and cost of equipment.
How has interest rates, if we think about software or prime rate, whatever you look at as kind of a benchmark, with that climbing, does that mean that your rates that you would charge companies increase by the same amount? Is it kind of a fixed spread, or does the spread shrink when
it's got higher? I think the appeal of, or one of the challenges of infrastructure credit over the last probably decade has been it's almost too low risk for investors that the returns been quite low. So some of the initial investors in infrastructure were investing in infrastructure to generate a 3 or 4, maybe at most a 5% return. Now, if you're in Europe and government bonds were negative returns, or if you're in the US and they were 1%, that was pretty good. Now it's higher, and a lot of infrastructure debt, particularly in the sub-investment grade space where most investors focus, is floating rate. So it's been quite interesting watching how infrastructure credit has performed relative to infrastructure equity. Infrastructure equity is a lot long-term, a bit more bond-like. Infrastructure debt, particularly floating rate, has really responded one-to-one to higher rates. So a lot of our investments are linked to SOFR. So every quarter as SOFR goes up, we reset the interest rate. The companies themselves often hedge that through interest rate hedges. So the risk to the company of higher interest rates is hedged with someone else. But from an investment perspective, we've got a floating rate investment. So infrastructure credit has performed very well in the last couple of years. As rates have increased, just the returns of infrastructure credit have grown in line with that. And certainly in this environment of higher for longer, I think, is where we're seeing rates today. That may change any moment now, but for now, let's call it higher for longer.
It's always for longer, whatever it is.
Yeah, it's always for longer until it's not. But the infrastructure credit returns are now higher than they've been historically, and relative to equity are looking quite attractive. And again, to be investing in infrastructure with a sort of a high cash yield, an all cash yield is increasingly attractive. So I think through this rate transition, what we've seen is infrastructure credits certainly become more of interest to investors relative to infrastructure equity, because its ability to quickly respond to the changing rate environment, but also it's debt, so it's lower risk in this sort of environment, greater uncertainty. I'm sure at some point markets have a wonderful way of being efficient and normalising. So, I think we're already seeing it today, actually. Sort of the returns available in infrastructure equity are starting to reset the current rate environment. But still, higher rates mean that infrastructure credit is quite increasingly attractive to investors as a sort of a high cash yield alternative with the resiliency that comes from being backed by infrastructure.
What have the returns been for investors? I don't know if there's aggregate numbers, expectations.
Yeah, I could talk really generally to aggregate numbers, certainly not to our specific performance, but it mirrors really what's out there in the market. But I think what we generally see today in the investment grade world, investment grade infrastructure credit, depending on the market and the credit quality, can deliver returns to investors anywhere between 4 to 6% net returns Sub-investment grade senior is sort of somewhere between that sort of 6 to 10%. And then mezzanine subordinated debt, the times can be equity-like, at times it can be more credit-like, but it's that more high-risk mezzanine and subordinated that's typically north of 10%. At least that's what we're seeing, particularly in the US. You've got a slightly lower credit rate environment in Europe, and that's certainly creating slightly lower returns, probably a little bit more lending competition in Europe, but the alpha or the value has remained pretty consistent in investment grade. You're generally achieving 1%, a little bit higher sometimes, above public market alternatives. In the sub-investment grade space, you're typically somewhere between 2 to 3% premiums. So it obviously varies. And there's obviously, I should put the compliance disclaimer there, there's past performance does not reflect future performance, and investments change. So there's always a qualification to that. But there are hopefully some indications for your viewers to sort of understand typically what's out there in infrastructure credit in the US and globally.
Yeah, thanks. No, it sounds like you're in a space that provides returns, low default, low competition, right, among credit providers. So exciting space. So look after various opportunities. So hope our viewers have learned a lot. So with that, maybe you can tell us more about your company, Vantage Infrastructure.
Yeah, happy to. I mean, it's Vantage Infrastructure. Our legacy goes back to the 1990s to be one of the first private infrastructure companies globally. And today, the Vantage Infrastructure platform is a credit specialist that operates globally. So with teams in New York and London, we invest across infrastructure debt mostly, all the way from long-term investment grade through to holdco mezzanine across North America, UK, Europe, and Australasia. So, it's certainly been, we have a good time with our business. It's certainly infrastructure credit's been a very interesting market to be in. I've been in it for over probably 25 years in one way or another. The platform that is Vantage and the team today, we've been together for over 10 years. So we've seen quite a lot of these market cycles and opportunities. And I think that's one of the things that we're quite excited about today. The market continues to evolve and grow. The ways that investors can participate in the space is growing, and the diversity and the choice, particularly with energy transition opportunities coming up. Infrastructure credit has really been a core strategy for a number of investors to get early stage access to energy transition investments, as well as a very wide diversity of other things. So hopefully that gives your viewers a little bit of an understanding about us and Vantage, and I think our journey in infrastructure over the last decades and hopefully many decades to come.
Yeah, thank you so much. Thank you so much for your time. Thank you for being here with us.
No, thank you very much. It's been a pleasure, and I'll look forward to hearing the feedback from your viewers and readers.
We'll get in all the comments. So thank you all for watching. This has been the Financial Thought Exchange podcast. I'm your host, Lotta Moberg, and we will see you again soon. Thank you.
Thank you. Bye.
For more information, please visit rpc.cfainstitute.org/research-foundation.